At this point, I'd like to introduce our third speaker, Tim Collins, partner with Collins, Dobkins, and Miller, LLP, law firm, and our previous executive director here at the Rent Guidelines Board. Welcome, Tim.
Thank you. Thank you, Mr. Blackston. I'm just being chair for the day.
It is.
Congratulations.
Thanks.
I'm a little disappointed Ms. Williams-Willard just walked out and she had to, because I think my testimony speaks directly to the issue that you raised. And we will get into that.
Can't hear you.
Oh, yeah, just turn on your mic.
Can you hear me now? Okay.
Is your mic on?
I'll try and speak up.
I don't think his mic is on.
Is it real?
Green light on?
It looks like it's on.
Okay.
It needs to be turned up. Okay. As I was saying, and I'm glad Ms. Williams-Willard came back because I want to address exactly what you talked about. And I think she's asked several questions. That is the question. What has the board done in the short run, the medium run, and the long run? And I think that you asked that question sincerely from your comment on the board, from what I witnessed. I believe you're very sincere. So you want to see housing both.
I had a brighter light. Maybe that's better. Thank you.
Much better.
As I was saying, I think Ms. Williams-Willard, and I believe everybody on this board, I know there's a few newly appointed members who I haven't had a chance to meet, but it's always been my experience that people come to this board with a great deal of sincerity and wanting to balance two very difficult things. And it's probably worthwhile at this point to kind of mention the elephant in this room, and the elephant that is in every government office in the country, every living room, and should be in every boardroom. And that is the simple fact that wealth has shifted dramatically over the last several years. What we're experiencing here in New York is not simply a housing crisis, but a series of tenant affordability studies and other reports show that what we're experiencing is a decline, perhaps even a disappearance of the middle class. And that's happening nationwide, and the consequence of that is that even while owners are trying to provide housing with the kind of returns that they've come to expect that a normal market might produce, they're also faced with a body of tenants, existing tenants and prospective tenants who've suffered from a decline or a flattening of income for several decades. I think the best evidence that I've seen is that sometime in the mid-1980s, the wealthiest 1% or the bottom 90% of the country held about 36% of the nation's wealth. Today, that's in the low 20s. I think it's around 22%. While the wealthiest 1% are now somewhere in the low 40s, around 43%, and in fact, it's become hyper-concentrated. The wealthiest 1/10 of 1% of our nation now holds more wealth than the bottom 90%. So it not only implicates issues of social justice, but we also have to be concerned about the stability and viability of maintaining a free republic. And we may have to think about, fishing out those keys that the framers left us in Article 5 of the Constitution and start thinking about how we can prevent oligopoly from calcifying and controlling our lives, which I think is a very serious problem. And it spills out in significant ways everywhere, including in the city of New York, where housing is something that is in great demand, and it's very expensive to supply, and people are struggling with how do we keep families in safe and habitable units, and at the same time provide the kind of returns that will cause owners to maintain and continue to invest in their properties. So let me step back from the elephant in the room, and we'll ignore that for this, because that's really not your job. Perhaps when we propose a constitutional amendment, you'll all endorse it, but we'll wait for another time. So let me thank you for the opportunity to again testify, and let me thank the RGB staff for another year of excellent and helpful reports. As most of you know, from 1987 to 1994, I served as counsel and executive director of the board. In the late 1990s, I worked under contract to update and complete various briefing materials, most of which are included in the introduction of the Rent Guidelines Board that you've all seen, and is typically given to new members as they're appointed. In last year's testimony, I spent a good deal of time discussing the board's legal mandate. Without reviewing that in detail, I generally concluded that when considered as a whole, the declaration of emergency and mandated considerations compelled the board to attempt to construct or to simulate normal market rents where abnormal conditions prevail. And that is, basically, I think, the distillation of what your mandate is. So you have certainly a more specific set of obligations to look at particular market factors. So how does the board go about establishing what rents that might be otherwise might otherwise exist in a normal market? Certainly, a review of operating costs is essential. As costs go up, so generally do rents. The board has two major instruments available for measuring costs, as you know, the price index and the I&E report. And the I&E report suffers from a lag of 1 year, suffers from a lack of inclusion of smaller units, although, as I've mentioned in the past, on a longitudinal basis, from point to point, the I&E report should be pretty reliable in showing cost trends, but it's true that it doesn't capture those smaller units. And the price index, which was a measure of a hypothetical market basket of goods and changes in that, has had its own problems, which I think were pretty well documented in last year's report by Jim Hudson, and it's been adjusted this year. The price index is adjusted by some of those findings with the expenditure weights from the I&E data. So that's an improvement. And while those adjustments actually caused a reported increase in operating costs, in other words, one could argue this is, you went from apples to oranges, and that we have, a new set of expenditure weights which is different from last year, and therefore we got this slight bump in where the price index otherwise would have been. It probably would have been negative. I think the report establishes that. Had we gone with the traditional market basket, methodologically, it's an improvement. And I'm not going to stand here and say, because the numbers went in a direction that I may not favor, or the people I represent may not favor, that it's a bad thing. It was a good thing. And hopefully in the future, it will help to stabilize the price index and make it a more useful tool for us. I do think that the board would be better served if the I&E data could be gotten on a more current basis, and we use that directly, or if the board had access to income and expense statements directly, as they do in the outer counties. Now, the central and clearly most important product of all those measures is the operating cost to rent or income ratio and changes in the ratio over time. If the O&M to rent ratio remains flat, owners have been kept whole from operating cost changes. That's pretty much a mathematical fact, and we're at 60.7% now. And if we stayed at 60.7%, it basically means that net operating income would be stable, and the amount that's devoted to operating costs would be stable. Absent other factors, a stable O&M to rent ratio is an indication that the board is holding a steady course. If that course permits cost-push inflationary factors like oil, labor, or insurance costs or taxes to be recaptured in rent increases, the board is simulating normal market conditions. If that course permits the city's exceptional demand pull inflationary pressures to force rents up, that is, rent increases driven by an abnormal imbalance between supply and demand, then the board is departing from its mission to establish rents that might otherwise prevail in a normal market. Before turning to the basic trends in the O&M to rent ratio, there are two other factors the board should consider when evaluating whether the prevailing ratio is too high or too low. The first is the relative age of the housing stock. As buildings age, operating costs will generally increase relative to rents. And as I mentioned last year, I'm just reiterating it here, the housing stock has clearly aged. We have no precise numbers on the median age, but we do know that in 1981, 80.3% of the stock was over 20 years old, and in 2011, 94.5% of the stock was over 20 years old, and I don't have the more updated figures from the 2013 report. So one can easily conclude that from this, that new construction has not been sufficient to keep the average age of the housing stock from rising. In a normal market, this would mean that the O&M to rent ratio would have crept forward from where it was 30 or 40 years ago. The second factor, and I think this is actually the biggest factor, is the impact of a recession, or particularly declining or flat tenant incomes. If household incomes are flat or falling, rents generally dip or sputter along until the economy picks up. This was evident during the recent recession when the national median asking rent for the first quarter of 2009, the $723, actually exceeded the median asking rent 4 years later in the first quarter of 2013, that's $718. So rents actually were pretty flat throughout the country. They kind of went up and down a little bit, but basically were flat over that 5-year period. And I think, if I'm not mistaken, I think I stuffed this in my pocket somewhere. Excuse me for the lack of preparation, but I do have it here. This is my alternative filing cabinet. It's my left pocket here. So this is a letter from my co-op board, and it's just anecdotal, but I think it's kind of instructive. April 6, 2015, from the management company for my co-op, which is up in Westchester. The Board of Directors has adopted an operating budget for 2015-16 fiscal year, and the budget calls for an increase in the monthly maintenance charges of $1.50 per share. This increase, which is the first increase in 6 years, is needed in order to meet operating expenses. I think it's been the experience of a lot of co-ops that no increases were needed for a period during the recession because operating costs were quite flat. In sum, as a structural matter, in normal markets, O&M to rent ratios will gradually rise with the relative age of the housing stock. And as a cyclical matter, a recession will limit rent increases or even cause a decline in rents. And this typically results in a rising O&M to rent ratio. So if the O&M to rent ratio, and I look at the audited O&M to rent ratio, I think that the study that was done a number of years ago, they looked at 50 buildings, Department of Finance, is now getting close to obsolete, and perhaps it may have been an adequate sample then, but it certainly should be a broader sample, and it should be done. But I wouldn't throw out the fact that the city's Department of Finance, in looking at those income and expense statements, found that a lot of capital items, which are compensated through the MCI program, and other types of items which were not properly listed as repairs, did not belong in the expense column. So they reduced the reported operating costs that were reported by owners by, as I recall, about 8%. I don't think we could just throw that out the window. I don't think there's anything to indicate that owners have become more virtuous or honest over the last 20 years or so. But there's no question that just in terms of professionalism and statistical reliability, that should be revisited. Perhaps that should be a resolution on the part of the board to have an updated set of audits, and they're not that complicated, and I don't think it's done in connection with any enforcement proceeding. It's just a matter of professionals in the Department of Finance looking through the filings that are made to see whether or not new roofs or new boilers are being stuck in the expense column where they don't belong. So that's something that's worthwhile. As I noted in last year's testimony, using the best evidence, we can assume that at the time rent stabilization was first adopted in 1969, the average landlord was spending about 62 cents of their rent and income, of rent and income collected on operating costs, keeping about 38 cents per dollar. With the aging of the housing stock, this ratio should have gradually risen over time, and at this juncture, an average ratio of 65 to 68 would neither be surprising nor troubling to me, especially in light of the effects of the recession and the lack of advancement of tenant incomes. And I'm just going to go through this quickly. This year's I&E report showed that it was 60.7%, virtually unchanged, only 0.2% from last year. And this ratio has witnessed a fairly steady decline since 2008, when it was 64.3%. Now, the thing that's really troubling about this is that, the decline occurred, which meant that owner incomes increased substantially in the heart of the recession. When tenant incomes were in decline, and more recently they're just kind of sputtering along, owners had done quite well. And the effects of the increases by the Rent Guidelines Board during that period are still with us and still sort of being implemented. Last year's guideline being the first by a relatively newly constituted board, and now hitting the market just starting in October of last year. So despite the aging of the housing stock and declining tenant incomes, which should have caused the O&M to rent ratio to rise rather, then the and net operating incomes to decline, the actions of the RGB and the operation of various statutory deregulation provisions sent the ratio sharply down and net operating income significantly up. It is therefore completely unsurprising that the RGB staff now reports that owner net operating incomes are 34.4% higher in constant 2014 dollars than they were in 1990. With respect to tenant affordability, it's not surprising that between 2008 and 2013, median rent paid by stabilized tenants jumped from 31.6 to 36.4% of household income. And I did this late last night. I think I got that right. Andrew, can you confirm that? Is that your recollection of your number?
The HVS number?
Is it the median rent moved from 31.6 to 36.4 stabilized? That is the correct number, right?
I believe so. Yeah, I believe so.
Okay.
I mean, that's the new number that, I'm quite sure the 36.4 is right from the new HVS.
Yeah. And at the same time, the ranks of the city's homeless have risen to by more than 50%, and this over the same period now exceeds 54,000 in a given year. And I think anybody who rides the subways or looks around the streets of the city can see that. There's just a ton of homeless people out there, and they just seem to be more and more. As I outlined in my testimony last year, the general direction of these deteriorating conditions were well known to the board by 2011 and known to members of the press as well. And I'm not going to repeat the details of that case. It was very clearly spelled out in last year's testimony. And I will add that, last year's vote suggests that the board finally started to get the message. I have appeared before this board almost every year for the last several years, and during a few years prior to and perhaps into last year, I felt myself becoming increasingly shrill about what I thought was an absolutely unnecessary and unwarranted increase in rents, and I described it as a march to the market. I felt that the previous board, primarily appointed by Mayor Bloomberg, was trying to engineer the gradual deregulation of the stock, which is not this board's mandate. That's a battle that has to be fought in Albany, not an easy battle to fight, given the influence of the real estate industry and the amount of money that's being spent and given in political donations, but nonetheless, that's where that battle has to be fought, and this board has to stay pretty close to its mandate. In that presentation, I was most concerned with a misunderstanding of what it means to, I'm sorry, I had a second presentation, and I wanted to clarify, and some of you may be asking the question which was raised last year, and it's an intelligent question. So if owner incomes are increasing so dramatically, is it the decisions of this board that are contributing to that, or is it other things in the market? Deregulation, more market rate units, and the statutory vacancy allowance, which is now typically 18 to 20% on a turnover, and other things like individual apartment improvement increases, MCIs, and so on. And so I wanted to isolate this board's actions and look at the pure trajectory or the potential influence of this board on rents. Now, some people have the misunderstanding that, well, if the price index comes in at 5%, rent should go up at 5%, or 3% should go up at 3%. And that is a misunderstanding of how we keep owners whole. And the staff has done reports on this many times, and people who sit on the board for a while, it becomes clearer and clearer that a simple one-to-one ratio of price increases to rent increases is not what keeps owners whole. And that's illustrated in part by the fact that this year's price index at a positive 0.5% is different from the net revenue commensurate formula, which accounts for the vacancy allowances, which would result in negative guidelines or a rollback with normal turnover. And that would actually keep owners whole. But if we look at the board's action over the long run, this year's exceptionally low price index, the 0.5%, and negative commensurate adjustments are actually quite minor points. I'm really not concerned about them here. I wouldn't care if they were 3% or 5%. It doesn't really make that much of a difference, because I think that the overwhelming trend looking back is very clear, and that the board has tremendously overcompensated owners in this economic environment, and greatly added to the city's affordability crisis, and it is an affordability crisis. And as I said before, you know, it's largely driven in part by sputtering and declining tenant incomes, but again, in a normal market, that would have a depressing effect on rents. In trying to construct a fair measure of the impact of the RGB guidelines, I tried to look at the various components of, you know, what goes into those returns. To compare rent increases to operating cost increases is to implicitly suggest that rent should rise at a comparable rent to operating costs. But if operating costs are rising faster than inflation, there is no reason why owner net operating incomes should rise faster than inflation. That approach would result in unwarranted windfall profits. So, for example, if the CPI is 1% and the price index is 5%, if you increase the entire rent roll by 5%, you're basically expanding net operating income at 5 times the rate that is needed in order to protect it against the effect of inflation, net operating income being only a portion of the overall rent roll. It's clear that net operating costs have risen faster than inflation over the last 25 years. In fact, according to the board's Table 7 from last year's explanatory statement, operating costs have risen 157%, or 159% if you look at the audited expenses since 1990. Over the same period, the regional CPI has risen only 87%. To find out what kind of RGB increases needed to keep owners whole, we need to multiply the percentage increase for operating costs by the O&M ratio. So you take basically the price index, multiply it times the 60.7 in this case. And the product of that calculation can then be added to the annual CPI multiplied by the net operating income portion. So you would multiply the CPI times the, what amounts to, I think, 39.3%. And then you would get, I'm using this year's terms, I use an example in the submission I gave you, but then you would get what it takes to cover the operating cost increases and to protect net operating income from inflation. I've done these calculations for each year since 1990 and updated the chart presented to the board last year. There were some changes that the staff had done in connection with certain components. I think the cost you know, as they update the price index by using the I&E data, there's a substitution there, and there were a few other adjustments that were made. I don't know if those were the result of reweighting or not, but I incorporated those into this year's chart, which is on the last page in the submission. The utilization of the RGB staff rent index is what is most critical here. That index is a projection constructed from actual RGB guidelines, the prevalence of 1- and 2-year leases, and the number of vacancies each year. It is as close to a pure reflection of the impact of RGB guidelines on rents as one can get. It ignores changes in income from unregulated or commercial units. To accomplish this, I used a base of 100 for 1990 on both the annualized commensurate and the rent index. Doing these calculations results in a 142.28% cumulative increase in the annualized commensurate since 1990. That is, if rents had been increased by 142% since 1990, and all other things being equal, owners would be fully compensated for cost increases, and their net operating income would be fully protected against the effects of inflation based upon the regional CPI. They would be kept whole. But in fact, the annualized commensurate since 1990, the cumulative increase was not 142.28, but it was 188.15. This means that the increase authorized by the RGB since 1990, starting in actually 91 when it was first measured, exceeded the amounts needed to keep owners whole in all respects by 45.87%, or an average of 1.8% per year. This rate of overcompensation is 32.2% over time. In other words, when I talk about 45.87%, I'm just looking at the difference between the 188 and the 142. But as a ratio, it's about a rate of overcompensation from my perspective of about 1/3. These findings with respect to rent increases are quite close to what I have found using the RGB rent index. The difference is that the I&E data uses all rents, including unregulated rents, while my calculations rely only on RGB authorized rent increases. And I should add there that I believe that also incorporates vacancy allowances. There are, as always, some complications. We know, for example, that the number of preferential rents has risen in recent years as a number of units exceed the actual rents authorized by the board or allowed by statute. We know, but we don't know how prevalent these are or how deep they are in their effect. And we can safely say that increases in regulated rents have greatly exceeded both operating costs and increases needed to protect net operating income from the effects of inflation. I think this analysis gives the clearest picture of the effects of the board's past actions on real owner net operating income to date, isolating those effects from increases realized from unregulated and commercial sources. All other things being equal, based upon the best available evidence, the RGB has substantially overcompensated owners with excessive rent increases since 1990, most of that coming in the last 12 to 15 years. And this level of overcompensation is so extensive as to totally eclipse in policy importance the one-year dip in the price index this year. All critical data points, both long and short-term, overwhelmingly support a rent rollback in 2015. And thank you for your consideration. I again apologize for being a little late. I thought I was supposed to be the last one on, and I was expecting to start around 11. So I'd be happy to take any questions.
Thank you very much. Any questions for Mr. Collins?
So Tim, thank you for coming today. So I assume we're going to hear from landlords representatives later on today that if we do a rent rollback or even a rent freeze, it'll have, you know, huge detrimental effects on the real estate industry in New York and cause crisis throughout the industry. How would you respond to something like that?
I think given the overall profiles that you have, and I think the relative number of distressed buildings, which is still quite low, there is always an impact. When you raise rents, it's going to cause people to lose their homes. When you keep rents down, it's going to put some pressure on those owners who are operating at the margin. I think you have to ask yourself how many owners are operating at the margin, and given the long-term trends, would a rent rollback cause any significant, really deleterious effect? And I think given the state of the market, which is very good from an investor's perspective, I don't expect that to happen in a big way. It's always a question of balance, but I think the balance is tipped greatly in favor of owners over the last few decades, and particularly the last 10 or 15 years. And I don't think it would have an immediate impact. I would be happy, and I know most of you probably don't believe this, but I have done this in the past. I would be happy to come in here and say the board's doing a great job, staff's giving you the information you need, you're basically charting a pretty close course to what the board's mandate is. And in years when I finished working for the board and doing contract work, I would often come in and say that, and I wouldn't make any kind of specific recommendation. I don't really have one today. But I would say that, by and large, you're doing your job, and here's what I'm concerned about. Sometimes I think, I've testified, we got to tap on the brakes a little bit. But in light of what happened, during that critical period when the economy went down and tenant income started to decline, and the board just authorized increase after increase, some of which were based upon innocently erroneous information, and some of which I think had to come from some kind of an ideological perspective that, rent regulation is somehow unholy and that the market will solve all problems. Market's not solving problems in this city. The market never has solved all the problems in this city. If you look back in the 19th century and early 20th century during periods of without rent regulation, there were very serious, in fact dangerous housing conditions in the city and overcrowding and I think, from a more subjective perspective, a great deal of exploitation. So the problem really is an income problem, and it's partially a problem of the special stresses that are experienced in a densely populated urban area where we need, zoning regulation, landmarks, and so on to preserve the quality of life, which, a lot of owners say, well, if I could tear my brownstone and build a high-rise, I'd make a lot of money, but they don't think about the fact that those zoning regulations and other land use restrictions actually have enhanced the value of their brownstone by making housing more of a scarce commodity. So the scarcity that the city experiences, to a large extent, is driven by government, which to a considerable degree is caused by concerns of quality of life and so on. And the consequence of that is a tremendous windfall in terms of market leverage for owners of existing properties. And I think your job, to a great extent, is to kind of mitigate that windfall and make sure tenants are paying what we would consider reasonable rents, and that building values go up at a reasonable rate, and that there's some level of stability. And so I don't think that in this city at this time, nor for its entire history, that moderate rent regulations are, a bad public policy. I think they're very good public policy, but they're a little bit rough, and they're heavily politicized. And the fact is that, the real estate industry periodically dumps tons and tons of money and, advertising, often in Albany when the laws are up for renewal, that give a very misleading picture of what's at stake with affordable housing in New York. So that's a long-winded answer to your question, the short answer is really no. I don't think a rollback would have any immediate or significant bad effect. I think if you did a rollback for a couple, 3, 4 years in a row, then yeah, you would have a significant effect, even with the level of overcompensation that owners are, having now. I don't think rents should be reduced by 10% this year, something short of that, but
what would that look like? What's short of that? Would you venture a guess? Would you venture an opinion?
I never like to see the board do anything that was sharp in any direction, So, if the board rolled back rents 2% for 1 year, 4% for 2 years, I'd say that that's a reasonable start at, restoring a fair balance. Could be a little deeper, hopefully at least that much. But I'm also very mindful of what's going on up in Albany on June 15th. Whatever this board decides is going to be closely scrutinized by our good friends up there, many of whom don't have a single rent-regulated tenant in their districts and really don't give a damn what's going on in the city, but yet they collect an awful lot in campaign contributions from the industry. And so if you do something really radical, like if you did roll back rents 10%, and that was, you didn't have sufficient statistical ammunition to support that, then I think we would see the industry using that as part of their arsenal to convince Albany that the city is not responsible and that this is a newly radicalized and board which is doing nothing but the tenant's bidding. A rent rollback of 2 and 4% would be doing the city's bidding, because the city needs more affordable housing, the owners can absorb it, and the tenants desperately need it, at least a good portion of them do.
Any other? Go ahead, Tim.
I just have a question. One thing that I struggle with in the data is, it is 1 million units, and there's a lot of individual stories, both on the tenant and landlord side. So the broad brushing of it is hard for me. It's not a secret. I work for a company that's building a lot of affordable housing, and I look at our models, and I hear the commentary that owners are making too much, et cetera. Even a 1% increase crashes the model. The margins are so thin on new construction affordable housing. So do you, in your history of working with this board, see that there's any way to segment this 1 million units of housing into something that's equitable for the various constituents within it?
Yeah.
That can meet some of the, there's a matrix of issues. So to say the owner used oil and gas, and they had this and this, and, you know, I had a building that has steam, and our steam continued to go out. You know, there are different things in the matrix that I'm struggling with.
Yeah, no, I think that's a great question, and there is, but I think we have to look at it in two ways. First of all, we have to think about, you know, what is truly governed by rent regulation and what is governed by other programs or, you know, an absence of programs. Newly constructed housing in the city, at least market housing, is not rent regulated unless the owner voluntarily opts into the 421A program. And it hasn't been for many years. So you can build market rate housing in the city. And in fact, you can enter into a contract with the Department of Housing Preservation, with the DHCR, Division of Housing and Community Renewal. I think it's for up to 50 years to be protected from any future rent regulation in the absence of a national emergency. So there are protections for market rate builders. If you're building affordable housing, the pressure that you're having is really driven by the market, you know, for land, accessible building sites, and the cost of construction, which clearly puts a lot of pressure on rents. But I would imagine that in most of those programs, if not all, the rents are structured to accommodate that, although the margins are very thin. That doesn't answer your question of what do you do with the actual owner of a rent-stabilized unit who's truly, you know, not making a reasonable return for whatever reason. And there are some odd, you know, kind of kinks in the system. For example, people who've had very long-term rent-controlled tenants whose rents have been very low. They haven't done their annual reports to certify that, you know, the violations have been removed and that sort of thing. So they got a rent stuck at $200 or $300. Those things still exist. They're not as common as they used to be, but that could have a significant impact on an owner. In some cases, you know, there might be an old rent reduction order that the owner never took care of, and it kind of freezes the rent-stabilized rent. So I think there are pockets of that where the regulatory system is just choking the building. I think they're fairly rare, but I think they're out there. And the way that I would recommend dealing with that, and I have in the past, is a reformed hardship mechanism. You know, so if this board wanted to do what it has done in the past, and I think constructively, because over time you do become some of the most informed housing people in the system, and that you're looking at an awful lot of reports, you're seeing, you know, you're getting kind of a bird's eye view of what's going on, and then with the testimony you get a more ground level view of what's going on. So I think the board should use its influence through occasional resolutions to get reform, and one resolution I would support is a reformed hardship proceeding, so that owners who truly are getting, you know, building-wide rents that are below what is reasonable have a more streamlined mechanism. The hardship system is there in place. It's in the rent stabilization code. There are two alternatives, neither of them which work very well. They're very slow, you know, bureaucratically cumbersome, and there should be a much simpler way, perhaps based upon census data, looking at specific districts. You know, if your rent roll for a building of this type, you know, old law tenement or whatever in this district is not producing a rent roll at this level, then you could have some kind of graduated additional increase to get to that level. I really don't think it would affect that many buildings, but I think it would be something that would help address, I think, one of the more legitimate concerns of owners, and that the system is just too damn complicated and slow to resolve those situations when they arise. But then you have to consider, you know, some owners have real serious problems. You know, their whole plumbing system or electrical system may be shot. So they have to do a tremendous amount of work. It costs a lot of money. You know, units may be offline for a while. Tenants may be complaining about habitability issues and so on. So often the decline in income is just age, and, you know, but you also have to remember that buildings that are purchased in that condition or owned for a very long, well, if they're purchased in that condition, typically a very low purchase price is paid. You know, owners, you got to remember, you don't regulate anybody's profits. You really don't. You have an impact on profits, but you really don't regulate profits because you don't control the price that investors pay for rent-regulated buildings. They pay a market that is based upon existing rent rules and operating cost profiles. So they're going to be making market decisions. And in fact, the value of rent-stabilized buildings has gone up, I think, at a rate that's dramatically higher than the rate of inflation, which shows that by and large, most buildings are profitable and getting sufficient returns.
I have a couple questions for you, and also a couple clarifications. And again, this sort of always seems to be my legacy, is I'm so dogmatic about making sure I understand the formulas and the terminology. Just to get this off the table, you use the term on page 5 that approach would result in an unwarranted windfall profits.
Right.
Like last year, and I will again this year, clarify that net operating income does not equal profits.
Yeah.
Okay, I really want to have everybody understand how net operating income is calculated. That is revenues from, in this case, the way that this NOI is calculated, in this format, is revenues from both rent stabilized as well as market rent units in what's considered rent stabilized buildings, which is any building that has at least one rent stabilized unit. So this is a mixing and a mingling of revenues that are being received in what our world is, which is the affordable housing that we're building, our respective companies and affordable housing developers, both for-profit and not-for-profit developers. There is no market rent revenue coming in. I just want to clarify that. And those rents are set based on AMI and not on CPI or any of these other things that you were discussing. So
can I just add one point?
Yeah.
And that is, the incomes that you look at from the income and expense data is building-wide income. Right. You're right. It's it's got everything in it. You can separate rent from overall income, including commercial. Right. But in constructing the analysis that I did, I only looked at what this board authorized, coupled with the vacancy allowance, which was board created initially, and then it was statutory. So I only look at, I don't look in looking at the income side, I don't look at the actual income. That's in the figure that the staff comes up with, the 32% rise in net operating income and inflation adjusted dollars since 1990. That's not where my numbers come from. My numbers come from the statistical, or really the mathematically projected effect of 1- and 2-year lease increases and vacancy allowances, and an estimate of the prevalence of 1- and 2-year leases, as well as the turnover rate. So and the size of the stock. So it's really a mathematical application of what we think that the reach of the board's orders.
But you have to then be making a series of assumptions about 1- and 2-year renewal rates, as well as the turnover in those. You're having to make a series of assumptions, whereas
the HVS data, it's pretty good stuff. It's not highly speculative. I mean, nothing's perfect, right. But I would think that the deviations are relatively minor. I think the board uses that, and the staff uses it in the explanatory statement every year in order to construct its anticipated, rent rolls going forward.
Okay, so the 34% NOI increase since 1990, and I actually really like 1990 as a starting point. I appreciate that you carried that date all the way through, because again, one of my grievances has been that we use selective listening on picking out time frames, whether that be the recession only, or prior to the recession, or the last 2 years. I think 1990 is a fairly good starting point in terms of looking at things trending over time. So the 34% increase in NOI, and again, I'm sorry, just for just the sake here, just to explain that NOI does not equal profits. Revenues minus operating expenses equal the net operating income, and that is before you pay your debt service, and that's before you put in capital improvements into the building. And again, we talk about, and I'm presuming that MCI increases are in your, are you doing any kind of MCI?
In the rent index does not include MCI increases or individual apartment improvements or unregulated units. The rent index that I use is the staff's rent index, which again is the application of the board's orders to the tenant population based upon that allocation. But you make a very important point. There's a difference between profits and net operating income. Profits are your return on investment. You know, the bank may own 60 or 70% of your building. Their return is the mortgage interest that they collect. You may have only 30% of, or maybe even less because you may have had some growth in equity, but you have a limited investment. Your profits won't be determined until you look at both the rent roll as well as that growth in equity, and, you know, if you wanted to cash in on everything when you sell the building and you tallied everything up, you'd see what your real return was on that initial investment. We don't have that information, and I don't know that anybody has that information.
Well, you're talking about a total return when you involve selling the building. But again, what I've discovered over time is that you guys don't want buildings to be sold, and we would like to have these things be healthy investments without having to sell. So again, both sides are actually wanting the same thing in often case. Yeah. So I don't agree with the total return analysis. I don't think that's a relevant exercise here. I'd like to look at what these things are from an operations standpoint, in the whole period, in the actual,
right. I think
in the operating
profile is what determines the health of a building at any given point in time. I don't disagree with that.
Okay, so the cash out equity thing.
But people often confuse profits with net operating income, and if you look at the growth in the value of buildings, I think profits are much higher than what operating incomes would indicate. But that is not a real relevant concern of the board, nor do you have a sufficient amount of information to, you know, really determine what.
We concur on that. And I'm making sure that people understand that net operating income does also not equal profits in the text of what actually goes to the landlord. So I hope everybody was clear on how that calculation works, and it is before debt service, and it is before capital improvements in the building. A couple of questions then, actually. I'd like to get numbers from you. The 1990, because I do appreciate the way that you slice and dice numbers.
I don't slice
and dice. We're kindred. No. We're kindred spirits in that. I think you do revel in the data, and I really appreciate the way that you're looking at these things. We may come at it from a different lens, but I do recognize that you're trying to get better information out there. From 1990, and again, thank you for creating that starting point, the NOI has increased by 34%. Is that?
No, in inflation-adjusted terms, yeah, that's the staff's number, okay. 34%.
And if I just did a straight, we obviously can't do a weighted average or anything like that, but just as a straight average, that's 2.26% per annum.
Yeah.
Okay, I just want to, okay, all I'm doing is I'm trying to create sort of like a list of data. I don't have an agenda with this, I'm really just trying to get the numbers.
Yeah.
So NOI on a straight average is growing by 2.26% over that 15-year period. Right. Operating expenses, you had a number of 159% over that same period?
The 159%, it's actually, my figure was 140, 159%, that's right.
So if I take, again, just simple math, the straight line average of that, over that same period of time, that's an average of 10.6% increase in operating expenses. Is that, sorry, I'm doing my...
Over 25 years? No.
I don't think those two are comparable, right? Because the net income already takes into account the increase in expenses.
No, I'm not using them as comparisons. I'm using them as trying to isolate because we talk about these things in whole growth, like what from 1990 through today, what the growth is on
Yeah,
aggregate.
I'm actually-
I'm just trying to do straight averages. It's not to compare NOI to operating expenses. I just want to understand what the simple average is for all of those, for all of these figures when we're talking about whole growth. Because you make whole growth, sorry, I think I divided this by, so what is the growth per average, or per annum over that same?
Well, it's 157% unaudited and 159 audited. So if you take the larger number, 159, you divide it by 25, because it's 25 years.
Yep. Okay, so that's 6.36.
Yeah.
Okay. Let's try that's right. I'm sad to say that it's already 2015. And then you have, what was the other one I wanted to understand? The rent guidelines mandate. This was the other thing that was interesting. What you call the rent guidelines mandate, how is that calculated?
Well, the rent guidelines mandate is really just a legal concept. It's a statutory obligation. But I really have to go back to what you said before, because I'm not sure where it leads to. If we talk about a 6.3% increase in operating costs over the last 25 years, that's probably true. As determined by the staff's, that's just the actual dollar figure that the staff estimated from 1990 based upon the income and expense data divided into the actual dollar cost estimated in the last round. And actually, it might be over 23 years, because it only goes through 2013. Okay. So it might actually be a little bit higher, and there were some very high inflation years there in the late 70s and early 80s. So that figure is there, but the point that I'm making is that rents went up dramatically in excess of that, and that if you look at the CPI, which was only about 87% over that period, and this last year, I think the staff went up to February. I looked at the March figures. I think it's a -1 over the last year. We've actually had a little bit of deflation in the regional CPI over the last year. So owners wouldn't need a bump in their NOI to stay whole this year. So the figures that I give, the 142%, which is a composite of the operating cost increases on the O&M side and the CPI on the NOI side, in order to keep owners whole. So that 142% would preserve owner returns against inflation over the 23-year period that it was measured. And then actually there's projections into 14 and 15 based upon the staff's analysis of the impact of the guidelines, just to update it. It's not as accurate as the I&E data, but it's pretty good. So there you have, a need to keep owners whole is 142.28%. And in fact, rents have gone up, or the board has authorized 188% in rent increases, and along with those vacancy allowances.
I'm sorry, so what was that? What was that percentage again? I just want to make sure I have that. What is that percentage again in your calculation?
The 142.28 is a composite of the operating cost increases times the O&M ratio times the changing O&M to rent ratio, because it's calculated for each year, and the annual regional CPI times net operating income, to give a composite picture of what would be needed to keep owners whole year to year. So if the board had authorized 142.28% in rent increases, owners would be exactly where they were in 1990 in terms of their income protected against inflation. And what the board authorized, in addition to vacancy allowances that were included initially by the board and later by statute, were 188% increases. Not what owners actually experienced, because I didn't measure that. I only measured what the impact of this board's orders would be on the profile of tenants out there choosing 1 or 2 year leases and in given turnover. So in very neutral, pure, sterile terms, if the board had done 142%, owners would have been kept whole. The board authorized 188%, and the actual impact on the stock has been affected dramatically by other things like MCIs and deregulation and so on. So that when I compare my my conclusion about what this board has done, which is overcompensating owners by about 32% over that time, it happens to be pretty close to what the staff has found in terms of a 34.4% increase in inflation-adjusted net operating income. So the 34% increase is big because it's not just that incomes went up 34%, it's that they went beyond inflation by 34%. In other words, at a time when tenant incomes, household incomes, have been relatively flat, and they have been since really the late 70s, the owners were doing very, very well. Now, I don't think it's your job to be a social welfare agency and say, you know, we've just got to, protect tenants because they happen to be poor, and, or are you here to guarantee owner profits? You know, we don't need rent increases just because we think owners should get profits. You're here to simulate what would be a normal market. If we didn't have the unique pressures we've had with an in-migration of nearly 1 million people in the last 15 or 20 years, and with the restrictions on the stock and the, the unusual kind of pressures on the city, you're here to make sure that owners get a fair return. And I submit to you that a fair return would have been 142% increases, maybe a little more, maybe a little less, given the decline in tenant incomes at certain periods. But in fact, the board overshot the mark substantially. And I think that was, and I don't look into people's souls, and I think there are some people who think that markets work much better than governments, and in many respects they do.
Tim,
but, I think that the case for overcompensation is overwhelming. It's to debate it just...
Okay, I'm sorry, Tim, I want to just go back to the numbers.
Yeah.
You reiterated a number of times sort of your theory on...
the mandate?
The mandate. Well, no, the mandate, okay. That's a whole other matter unto itself. But let me ask you about, why did you use CPI as the holding point over that period? Yeah, for the NOI. Why didn't you use operating expense growth?
Well, because if the board had tracked operating expenses as a measure of what should be given owners, they would have gotten the windfall because, as I said, the operating expenses have gone up much higher than the rate of inflation. And if the net operating income to owners is increased at the same rate, then those net operating incomes would have gone up a much greater amount. It makes no sense. If you have, hypothetically, a building with $100,000 a year rent roll, $60,000 of that goes to operating expenses. So you have you get $40,000 for debt service and whatever out. You got to pay the bank and all that. So you got that $40,000.
And capital improvements, right?
Okay. And if prices go up, to make it mathematically simple, 10%, leading to a $66,000 operating cost budget, you wouldn't have to increase the net operating income by the same amount. In other words, you would want to get the $40,000, but you would want to increase it only by the rate of inflation in order to preserve it.
I don't agree with that.
Sarah and Tim, I apologize. I'm going to take a little license in terms of being the chair. We're already a little bit over time, and I'm sure Mr. Collins would make himself available to clarify some of these questions. And I appreciate the questions, and I apologize.
One thing, actually, another thing I'd love to have you just follow up with, not in this format, is you mentioned quickly that the outer counties, their RPIE data is in real time? Versus
the outer counties get income and expense statements, and my understanding is, at least for a while, if owners didn't file their income and expense statements directly with the DHCR for purposes of setting the guidelines, they were not permitted to get an increase. DHCR has subpoena power, which this board does not have.
I don't know more about that.
Okay, thank you, Sarah, and thank you, Mr. Collins, for your time, and we appreciate it. We're going to take a break for lunch, and then we'll reconvene around 1 p.m. for department owners' testimony. Okay.